everyone. Ben Nelson here. Thanks for tuning in again to another episode of the Everyday Real Estate Investor. Really appreciate it, and hope you're learning a lot. Hope you're thinking through some new things. Hope your mindset is getting where it needs to be for being successful in your investing and overcoming some of those obstacles that maybe you have had in your mind, and not thinking that you could get in the game, or not thinking you can up your game to the next level and all those things. So that's the whole concept and idea here is, iron sharpening iron here, and inspiring everyone and encouraging everybody to move forward in the real estate investing. And just we make each other better, right? So if we're spurring each other on and challenging each other, we can all do better. So I'm definitely a proponent of doing bigger things together and working together, and not just the competitive side of it. And there's, we're all looking for deals. There's competition, but we can work together and we can help each other. And I just believe in abundance, and that we can do that, and we can do more together. So thanks again for tuning in. We are going to talk today. I try to talk a lot on this podcast about concepts and tactics, and talk to other investors who have done, have been able to be successful in their real estate investing, especially, kind of starting out the mom and pop stories, right? You start out with a couple of units, and you just kind of build from there. Like when we talked to Evan Bellinger a few weeks ago, though we did talk about the market a little bit with Grant. I think that was, last week or the week before, but I don't talk a lot about the market. I don't talk a lot about what's going on in that world. I do market update videos. I do a lot of that stuff. I kind of put some content out there on YouTube. I've been doing a lot more shorts lately, just kind of giving insights on what's going on in the real estate world and news and that sort of thing. Try to give some perspective on those things. But I've not really talked about that on the podcast. So, just as a general rule, that's not the platform. The podcast is not really the platform. I talked about the market. If you want more of that stuff, check out my YouTube channel, and it's going to be on there. But if you're listening to this on iTunes or something like that, you're not going to hear as much stuff on the market. That's more on some of those other platforms. So, but today we're going to talk about it because there is a lot going on, and there's a lot of questions that continue to come up, and there's a lot of I think, in my opinion, misinformation and just misconstrued information out there. And especially if you just sit on the internet and look at article titles and headlines and all that stuff, it just drives me crazy. So anyway, we're going to get into it today so that we can try to, I don't want that kind of stuff. If you're sitting there looking at that, and it's really easy to get discouraged and just think that things are headed for the worst, and hey, I'm gonna put my head in the sand, and I'm just gonna hunker down and wait this whole thing out and see what happens. Hopefully I can make it to the other side, right? And you just don't do anything. You freeze, and you decide to just sit and wait, and you can miss up a lot of opportunity if you're doing that. So that's why I wanted to talk about this today, because again, the whole idea, like action and getting going and overcoming some of these obstacles, and I think the market and a lot of what's out there right now can be a big obstacle for people taking that action. So let's get over it. So let's talk a little bit about it. So the reality market is, yes, okay, things are slower than they were. Things are not selling quite as quickly. There's not a bajillion offers on a house the first day on the market. Things aren't getting bid up, 10-15% over list price. Okay, so yeah, the market's changed over the last 3 or 4 months. February, March was insane, and we were just like the activity levels, the prices, the bidding over ask, all of that stuff was going on, and very quickly with rates going up, being a big part of that. If not really the only thing. That was really the main thing that caused a lot of the slowdown, was interest rates going up so quickly. It's changed a lot. It's shifted, and I don't think shifted is really the right word, because when you think shift, you think like going the other direction, right? At least that's what I think. But it's changed a little bit. It's changed a little bit from what it was, quite a bit, right? So yes, it's different. It's slowed. But I see a lot of these down numbers. Sales are down. Foreclosure activities, like all these numbers are getting thrown out, right? Especially like sales numbers and things like that. Oh, sales are down. Sales are down. All of these things that are saying that. Well, okay, but let's look back and let's think at what were the sales numbers that we're comparing it to, right? If we're comparing it to last year, it was an insane year. It was like the highest amount of sales volume, I think, in a very long time. It might be ever, but it was. If you look at the charts, it's just this huge spike in sales activity. So if you're looking at these year to date or year over year numbers, they're gonna, yeah, of course they're down because it's down over what was a really really high number, right? So you got to be careful when you're looking at these numbers, and if you're only comparing it to recent history, you don't have the perspective of the long term. So if you go back a couple more years, yeah, you take those down numbers, and you go back pre-COVID, you are really kind of right in line with what we were back then. So that's the first thing. So yes, the reality is that the market is slowed, but it's slowed from like craziness, right? A crazy high level of sales volume, crazy high prices, and bidding wars, and our crazy number of offers, all of that stuff, right? So we can't compare to that because that's abnormal. So that's the first thing. You don't want to compare to what was abnormal. You want to compare to what is more normal, right? So another reality in the market, rates are starting to settle down. So we had a very short window where rates they going up every day. It was just, we went from 3%, 3.5% interest rates up to like 6.5% or something like that in June, I think. So they went up really quickly and significantly, right? So now they're coming back down again. I don't know where they'll land, but we seem to be in a more leveled off time that we're going to maybe move forward and have less volatility anyway than what we had. And really, again, going back, yeah, so 5% interest rates on a 30-year fixed, like, oh my goodness, right? So you go back a few years, yeah, that seems high, right? But if you look at historical norm interest rates, it's still a very, very good interest rate. And it shouldn't be something that stops you from moving forward, especially in investing. I get it from a, buying your personal residence perspective. And yeah, from an investment perspective, it changes your cash flow. So it does change how you have to calculate things and how you're looking at things. And it's probably going to affect, some asset prices, maybe in the multifamily space, especially where and not just in the multifamily space, but when you're looking at debt and you're taking on debt, now your debt's more expensive. And so, yeah, there could be a little bit of that, but overall, so yeah, you want to factor that in, but again, we're still in a very good interest rate environment, historically, right? Okay, recession. We're technically in a recession, right? So, negative GDP growth 2 quarters in a row, technical definition of a recession. Okay, well, that's true, but number one, it wasn't that much negative. It really wasn't. It was like 0.9, negative minus 0.9 GDP growth. Okay, so it was negative, but it wasn't a lot. And then I don't remember what it was the quarter before that, but it wasn't a lot either. It was a little bit more than that, but not a lot. And then again, if you go back further though, we had very high GDP growth for a couple quarters. So to me, it levels out a little bit. I know I'm not an economist. Okay, I'm not going to pretend to be, but again, if you have high growth and then now you've got a little bit of a pullback, I don't know that is fair to call it a recession. And the other side of that, or one of the other factors, you got to look at everything, right? Unemployment is extremely low. We've got a lot of other things that you have to look at in the economy that are still going pretty well, and so to call it a recession, and there's other experts that are putting that out, hey, technically it's a recession, but it's really not, right? It's kind of a fake recession because, yeah, GDP growth is negative 2 quarters in a row, so technically that's the definition of a recession. But we have all these other things going on in the economy that are really good. Now, inflation obviously is one of the big things, and that's why the Fed's been continuing to raise rates and all that stuff, but then they're trying to taper that, of course. So that's been a big pain point for a lot of people. But the economy has a lot that's still going strong, and unemployment's one of those things. So inventory is still really, really low in the market. Okay, so back in the financial crisis, we had a huge glut of inventory, like even before we had a whole lot of inventory, and just too much coming into the market. And then the downward spiral of everything that happened with the financial crisis and credit scores getting decimated and lenders stopping lending and all this, the whole spiral of values going down and all of that. Now you got all these bank-owned homes coming to the market and all that stuff. So it just added to it. Right now, we still have really, really low inventory. Here in the Portland metro area, we have less than 2 months of it. I think it was 1.5 months of inventory still. That's gonna climb a little bit because it's a function of absorption and how quickly people are buying, as well as how many homes are on the market. But we have our supply level is basically what it was a couple years ago, this same time. So there's not an oversupply of inventory. We're still in very much need of inventory. So inventory is still low. Affordability is a challenge, right? Okay, we've been talking affordability for years, and just that is a huge issue in a lot of markets. And now obviously, interest rates going up so quickly, that's just made it an even bigger issue. So that's the reality of the market. I don't know how that's going to work itself out. I would venture to guess that inflation has to hit wages more. It is started to, but it's got to at some point hit wages, and so that's going to help with some of the affordability in the sense that people are going to have a higher income to afford a higher home payment and the higher food prices and gas prices and all that stuff. So I think that's going to work its way through, and eventually, wages are going to have to go up, and they have. I mean, Portland implemented a much higher minimum wage. That's come. I think maybe it's all the way through now, but I don't know. It's like it was a staged thing, staggered, where over a few years. But yeah, so that's not really the economy doing it or the free market doing it. That's legislated, obviously, but it still kind of produces the same result, right? Then you got higher minimum wage, so the jobs above that are going to feel upward pressure on wages and all that, and so again, that helps with affordability in the end. And then we're in an inflationary environment, right? That's kind of obvious at this point. That's the big word. I think it was 9.1% or something. I mean, it's a huge number year over year. The last number that came out. So that is a reality of the market. And the thing is if you are buying assets and you are in an inflationary environment, then typically asset prices are going to continue to go up, because that is what happens, right? So you have less valuable dollars buying the same thing, and you're going to have upward pressure on asset prices. And so being in real estate could be a good thing, right? So what is not happening? This is also an important thing, because I think this is almost more important. It's important to know what's happening, but it's important to know what's not happening, right? Because the headlines are saying a lot of things that I'm not going to say they're not true, because there's truth in them. They're just half truths, right? You take the piece that sells the story and you put it in a headline, and then you get people to click on it, and it's super annoying, and that's how things work. But anyway, I won't go down that road. The first one is, being foreclosure activity, right? So foreclosure activity has spiked. It is up. I mean, I saw all sorts of different numbers, but basically it's, I think it's like 150%, up 150% from what it was year to date last year. Okay, so wow, oh my goodness, look at all the foreclosure starts that have started, right? We're going to see this slew of foreclosures. No, we're not, because again, what are you measuring it against? You're measuring it against an extremely low number, and part of that was due to, all the moratoriums they put on foreclosures and all that stuff, right, during COVID. But if you read those articles that say how high it's gone up, we're not even back to like the pre-COVID normal levels in foreclosure activities, foreclosure starts. So it's not even a relevant conversation, in my opinion, at this point. There were so many foreclosures that happened back in the financial crisis. We're nowhere near that. And kudos to, I mean, honestly, it could have been really bad with all, when we hit COVID, because there were a lot of people out of work, and there were a lot of like people that were behind on payments and everything like that, and that worked itself out through the programs they had, and everything that they were doing. So that did help. A lot of the people that lost jobs also were very general statement, but a lot of hospitality jobs, a lot of service industry, entertainment, the things people couldn't go to those places anymore, right? So those were the jobs that suffered, and there's a higher percentage, again, general statement of those jobs, people in those jobs are renters versus homeowners, right? So, but yeah, there's no slew of foreclosures coming on. We're not going to have this huge wave of foreclosures. And even if we did start to see more, the processes are so different than they were back in the financial crisis. The loans are totally different. We're not seeing the same. We didn't build the same system, but that caused a lot of the catastrophe. The lenders changed underwriting processes. We're not doing teaser rate stuff anymore. All sorts of things that are just completely different about this scenario. And again, I mean, people have equity, right? So, I mean, for the most part, why would it ever go to foreclosure? It's going to hit the market before it goes to foreclosure, even if people get behind on payments, because they have equity. So unless you bury your head in the sand and just ignore it, which people do, they do that sometimes when they're in that situation. They're probably going to say, hey, let's sell, let's get our equity, and they're going to sell on the normal market. It's not going to go to foreclosure. So we're a glut of inventory, right? So we're not going to see a glut of inventory. At least, I mean, for the foreseeable future, we're way behind on housing production. We have a lot of catching up that we need to do there. So, whether it's foreclosure inventory or just new construction inventory being overbuilt, we're not going to see it. We're not going to see that. We're not going to see a huge crash like we saw in the financial crisis. We're not going to see 20, 30, 40% declines in pricing. It's not the same storm as we had back then. And there were so many variables that led to that. And now all of these things that I'm saying, the caveat is that, again, there's no the real estate market. I say that in my market update videos all the time. The real estate market, when they talk about the real estate market in headlines and on, we're talking national numbers, right? So there's no such thing as the real estate market. It would be like saying the stock market. Unless you're buying the Dow Jones or, the S&P 500 or something, then yeah, okay, then maybe that's relevant. You can't buy the real estate market for the United States, right? You just can't. You're buying houses, you're buying buildings, you're buying in specific markets. Yeah, you could buy a REIT, I guess, but that's not really real estate. That's a stock. So, but yeah, so just with that caveat that all of this is like, yes, I'm speaking on a broad level nationally, and just keep in mind that everything is local and you have to pay attention to all of that, right? So there could certainly be specific markets that are going to have maybe a little bit of oversupply and have higher foreclosure levels and all of that stuff, of course. And then there's going to be some that don't even feel it, right? That don't have any foreclosures. And honestly, like the Portland and the Oregon market, they're like way down on the bottom of the list for potential foreclosures and pre-foreclosures, just as an example. So we're not going to see a mass exodus from real estate. We're not going to see people offloading. Real estate is way less liquid, which is why it's not the only reason, but a big part of why it's not as volatile as the stock market, right? You can go on and log onto your phone and hit sell and sell all of your stock, or vice versa, right? And so the stock market's very emotionally driven, and is affected by emotions because you can sell and buy so quickly. If real estate was that liquid, it would probably have more volatility to it, right? But it's not. So, but even if it was, people like real estate. It's tangible. You can affect its value. It's a necessary thing. People need to live somewhere. People need places to shop, to go to the office, to go to, all of those things. So real estate is very necessary, and that's not going to change. And people are going to continue to invest in real estate. There's not going to be a mass offloading of inventory, with the caveat of maybe Zillow selling off a whole bunch of their inventory. So, so what does this leave us? Where are we at in this market? What's the conclusion here? Okay, the sky is not falling. Don't listen to the real estate headlines that you're seeing everywhere. You go to MSN.com or whatever, any of the top headlines that it just like throws across. At least for me, probably because I read real estate articles all the time, and so that's what it's thrown at me. But almost all of them are negative, or at least the headlines are. And so make sure you dig into those headlines and read them and see what it's actually saying versus just the headline. Okay, fall for the clickbait, it's fine, but read into what the article actually says, and then vet the data, and don't just even take their conclusion and take it as the gospel, right? Challenge it and see if that actually makes sense. Prices in most markets are going to continue to go up. Okay, they're again, like I said, nationally you can say one thing, but every market is different. Every market's going to react differently. So for the most part, I think prices are going to continue to go up. We're going to see like more normal historical appreciation levels, this 20, 25, 30% annual appreciation that was like insane and is absolutely not sustainable. Of course, we're not going to see that, but we are going to see 2, 3, 4, 5% annual appreciation rate. So we're going to continue to see that appreciation. It's just going to be more reasonable historical level appreciation. So again, this goes back to like, it's really important to know your market and the market that you're investing in, and what's going on there, right? So know if you're invested in the right market, or if you maybe need to make a change to a different market, and to not, number one, align with your strategy, but number two, maybe a market's peaked, right? So again, individual markets may have peaked, and there are some markets that are starting to pull back, but there definitely are markets that are continuing to grow and have increases in prices. So know your market, know what's going on there, know what pricing is doing there, know how interest rates are affecting those markets. What is, what have these new interest rates done as far as affecting payments? What are income levels like? Is it a bit, is it a huge deal as far as affordability, or is it like an inconvenience more? And it's not an inconvenience, I guess, to pay more, but is it like kicking everybody out of being able to buy a house, and like that's a big deal? Or is it just now it's more expensive, now people are yes, they have to pay more for their mortgage, but they can still afford it, right? So those are all the things you have to look at. Are people still moving there? What's the demand? What's foreclosure activity like there? What are the drivers in the market? How are jobs doing? All of that stuff. You have to know what's going on in your market, because some markets are going to suffer and some markets are going to continue to do well. And if you look at my last market report, which I don't think I actually posted yet, I think I'm posting it here in a day or so, but it is really apparent when you look at some of the rent numbers, which I point out in that video, and some markets, the year-over-year rent increase is just insane, 70-80% in some sectors, and then there were markets that went backwards by 20-30% in rents. So you can average all that out, put it all in a bucket, and you're going to say, it's going to be a positive number, right? But in reality, one market did really, really well and one market did really, really poorly, right? So you got to look at your local market. You got to know what's going on there. You can't just throw national numbers on a local market and say this is what's going to happen. Last but not least, don't wait. Buy real estate, okay? Buy investment real estate. Don't let the headlines stop you from pursuing great properties. Just know what you're looking for. Adjust your underwriting and your criteria for the new norm of where interest rates are at. Again, know what your strategy is and what you're after. Know what's going on in your market, and just invest wisely. And you're going to do well. They say the best time to buy real estate was 10 years ago or 15 years ago. Well, the second best time is now. And I don't think that that's going to change, especially if you're smart about it and you're buying in the right markets and you're doing the right things and you're being prudent with your underwriting. You're going to do well. So don't let the headlines and the negative news and all of this stuff, and most of which is just trying to stir up the pot, and there's only partial truths in there. Of course, nobody knows for sure. There could be some huge thing that just totally throws off the market that nobody sees coming. Okay, so that aside, be positive about the market. I think that it's going to continue to do well. Just don't let it stop you. Don't let those things stop you from moving forward. Don't let it make you paralyzed. Go out there and buy some great real estate. So thanks again for listening. Hopefully this has maybe gotten you past some of those fears about the market and what's moving, coming ahead. And go do your own research. Go look at some of the things that I talked about today. Verify it on your own. And I think you're going to find out that there is a lot to be positive about moving forward here in the real estate market. So go out and buy some great real estate and make it a great rest of the day.